It's also coming at a time when we're seeing potential safe haven demand given a U.S. government shutdown being around the corner. But is it now a matter of technicals given how high the dollar is at right now?
Thank you for having me on the show today. When it comes to US government shutdowns, yes, it does create a bit of safe haven flows into the US dollar, but our research shows that previous shutdowns, during the actual shutdown, the dollar tends to weaken against other safe havens such as Swiss, yen and gold. But when the shutdown is resolved, and we may not get that resolution in the near term, the dollar tends to bounce back a bit. But we have to be concerned that how much this shutdown will impact the economy. Yes, you do get those safe haven flows, but once again, yen, Swiss and gold could benefit.
Let's talk a little bit about the Japanese yen first, because we are now headed towards that 150 level that some have said could be the threshold for intervention from policymakers. So where do we stand on how much weaker the Japanese yen can get, because you also have rate differentials at play?
That's absolutely correct. The widening rate differentials between Japan and the US are driving fundamentals for the dollar yen for it to move higher and above 150. But at the same time, you have jawboning from policymakers such as Minister of Finance Suzuki. Now, on the intervention front, it isn't just about the levels. We have to recall here that the Minister of Finance in Japan has to justify intervention to the US Treasury, particularly if it's in dollar yen, on levels on the grounds that it is curbing excess volatility. Now, dollar yen volatility, due to the intervention, the verbal intervention we've seen, has actually collapsed. We've got dollar yen caught in the smallest ranges in 6 months. We've got implied vol for 1 month is down at 6-month lows also. So it's a bit of a game of chicken, and this is the way the moth likes it, because the markets are afraid of pushing dollar yen high too fast and triggering intervention. Now, previously, former BOJ Governor Kuroda has defined excessive volatility as 2 to 3 big figure moves in dollar yen in a trading day, and we haven't seen anywhere near that volatility. So, again, markets are a bit afraid to push it higher, and that is keeping dollar yen sort of caught in that range. It can edge higher according to fundamentals, but investors, again, are afraid of that verbal as well as actual intervention.
David, as you mentioned, the Finance Minister, Shinichi Suzuki, he's actually speaking in Tokyo as we're speaking at the moment, saying that he's watching FX with a strong sense of urgency. Would they be watching just that nominal exchange rate, or would they be more concerned with the real effective exchange rate, given levels of inflation and how this potentially could really exacerbate, weakness when it comes to purchasing power?
That's an excellent question. So they do focus a fair bit on dollar yen because dollar yen is a very large weight in the TWI basket. They also focus a fair bit on the cross with the Chinese yuan. So if the Chinese yuan start, because they're relative competitors, but also you get a lot of export revenue or investment revenue coming in from China back to Japan, so they have to pay attention to that cross as well. In terms of the words being used by Suzuki, the words on our level of verbal intervention scales, they're level 6 out of 7, where 7 is warning of, yes, we're about to intervene. So level 6 are when they're saying they're watching the FX markets very closely, they're not ruling out any options to deal with FX, excessive FX volatility and things like that.